recording. So a little bit of context. I was just showing the class how yesterday we caught GA literally on the whole way up. Oh, and we still had the swing trade left on GA, which hit our TP for 109 pips. So literally off of one pair that we've milked this whole week, off one pair that we've milked, we've got 109 pips. We managed to catch 73. So let me actually do the math for you guys and see how many we have. So we have, let's see, 109 pips plus 73 pips plus plus 95 pips and then plus 87 pips. So 77 plus 87. So we caught 364 pips just on one pair yesterday. On one pair, we caught, wow, we caught 364 pips. Isn't that awesome, guys? Is that not absolutely insane? Because personally, I'm super proud of everybody. I'm extremely proud of the captains, and I am really proud of every single one of you guys who has been putting in the work recently to honestly just be an outstanding trader. Because the biggest thing about trading is getting that consistency that a lot of people don't have. So that's something that I think you guys are seeing here. You guys are seeing consistency, and I seriously can't wait for all of you guys to reach this level that you guys can take a look at a pair and you guys can absolutely milk that pair for all it's worth. So thank you guys for hopping on, by the way. If you guys have anybody that you guys would like to bring on to Empire, or they're a little skeptical and they don't know what's going on, let them know about this call, and we can actually get them to see a little bit of a different perspective on the market. Actually, cool. All right, let me get my board connected really quickly, because I need to get my board to actually draw for you guys, because everybody loves how I draw, right? All of you guys love how I draw. Oh shoot, my charger. Give me 1 second. So tell me, how have you guys' trading weeks gone? For us, it's gone really well. We've caught around 700 pips this week with gold. You guys have Declan to thank for that. Gold was absolutely amazing. And let's go ahead and join up on the board. Cool. Let me pop up the chat again. Good week. Yeah, Wishmar, actually I was just talking about your trade that you did absolutely awesome on. There we go. Awesome. Okay. All right. So after we knew what happened these past few days, let me go ahead and start showing you guys something really cool. So the market works on an algorithm, right? Like everybody knows. Okay. The market works on an algorithm. Now everybody knows this, and let me actually start. Oh yeah, no, it's recording. Okay. So everybody knows that the market works on an algorithm. Now, what does this mean? What it means for the market to work on an algorithm, essentially, basically what it's saying is that the market will have to price in as, get my whiteboard out. Here we go. There we go. Perfect. All right. So what basically I mean by saying that the market works on an algorithm, it's fairly simple. The market works like this. Let's say that there are a couple thousand people, and I'm putting this on like a little bit of a lower scale. So let's say that there's a couple hundred people. Let's say that there's like 200,000 people, right, going short on a certain currency. And there are about 500,000 people going long on a currency. What will the market result in this case? And I'm starting off basic because if you guys haven't been to one of these classes of mine, my classes are a little bit different from everybody else. Mine aren't advanced, beginner, intermediate. So I start off basic and then I go all the way to the advanced. So everybody gets a piece of the pie. So please, if you guys are a little bit more advanced, just bear with me. I will try to go through the basics as explicitly as I possibly can so that I don't have to repeat, okay? So the 200,000 and the 500,000, right? So Nita, you're absolutely correct. The market would absolutely rise in this case, right? But as you know, the market won't go from point A to point B, right, in one fell swoop. It won't just teleport there, right? It won't teleport there. What's going to happen is the market's going to do something like this, right? Let's say it prices in a couple thousand people and it pushes up, comes back down, comes all up, down, up, down. Who knows why the market does this? Who knows why it doesn't move up in one fell swoop? Who knows why? Or who can guess? It's fine if you don't know. You guys are here to learn. To be efficient. Okay, Irvin. Yeah. That's a good answer. Mitigation. Okay, that's also a good answer. So think about it this way. What if there was a way, okay, chasing left behind liquidity. Okay, true. To not simply crash. Perfect. Right. So the all of these are part of one answer, which is this is how the algorithm prices in. Right. An algorithm, like the definition of an algorithm is a series of equations, right, that end up that give a number. Okay. So it's a series of equations that give a number. That is where price comes in. That is where price is derived from. Right. I don't have the equation that that algorithm has, but let's say, that it's let's say that it's just a simple equation, right? Now, given the numbers, right, given these numbers, it outputs a number. That number is known to us as price. Okay. So think about it that way. And next, let's take a look at why the algorithm sometimes causes something called voids or liquidity voids or imbalances. Okay. Now, firstly, I need to tell you guys that you guys need to, just hold on a second and think about it this way. The market will not, and I mean will not, price in, like a lot of times we give examples in bank logic that we say, like, oh, a certain thousand, certain couple lots, right? Come in. Let's say that it's, and this is just an example. I'm doing this for numbers' sake. Okay, don't take this like this is how the market actually, like, this is the actual number. Well, let's say that there are 700,000 lots, right? And there are 200,000 lots, okay, in the market at one time. And let's say they enter at this point here. They enter at this point here. The market, right? Banks, market manipulators cannot enter the market all at one time. If they enter the market all at one time, there's a lot of regulations against that, for one. Two, there are it wouldn't be efficient because then the market would just take off, right? And when it takes off, well, that will lead to a lot of injected volatility, too much injected volatility. It could harm other big players in the market, and that will lead to very bad things, right? And it would essentially not be good for the market for it to price that way. So instead of that, the market makers will splay out 700,000 or 200,000. Actually, let's get rid of this number not to confuse people. These 700,000 lots that they put in, right? Uh, they are not going to enter just at point one, right? They're not going to enter at just at point A, sorry. Right? What they're going to do is they're going to move price down, right, to go to point B, right? They're going to move it a little bit higher and enter again at point C, right? They're going to push it back down just again to enter at point D again, right? What is this known as? There are two acceptable answers for this. Contraction, perfect, also known as consolidation. Accumulation, right? Because accumulation is a type of consolidation, perfect. What else? It has a number in it, and a lot of people have been having questions about it. It has a number in it. The alphabet, yeah. Power of what? Power of three. Perfect. Power of three. Exactly. So this is known as either contraction, right, which means accumulation, right, type of consolidation, and it can also mean power of three. Why? Because the market here also went short in this case, right? It went down to push price lower, take this liquidity, and push price lower into discount pricing in this case, right? Because our target's up here. We want to go higher. So it pushes it lower with the purpose of going lower and getting lower entries, right? Because us as smart money traders, we want to get the most precise entry that we possibly can. So now let's take a look at how the market goes along, and what do you guys think would happen if after a certain amount of time these 700,000 lots would get placed into the market? What do you think is the after effect of this? What do you guys think is the after effect of this situation? Expansion. Perfect. Expansion. Now, what do you guys think would happen in the market? What do you guys think would happen in the background? Maybe. Now keep in mind these are 700,000 lots buys, right? Buy lots. Do you see any sell lots? Right? Do you see any sell lots? Buyers with no sellers, supply and demand issues, right? So perfect. How do you pronounce? I don't want to mispronounce your name. Mr. Verma has the absolutely correct answer, right? It would be a void. So now let me explain to you guys something. This is the focus of the class. So this is going to be like the kind of the meat and potatoes of this class, okay? Now, what would happen if there are no sellers in this market? How many times have you guys seen this? How many times have you guys seen that? Just one candle absolutely ripping it. How many candles? Sorry, how many times? See it in the SPX, right? Happens a lot in indices. How many times have you guys got stopped out by these candles, right? When you guys were trading in retail, that you guys just absolutely get ripped, like your stop loss gets ripped because of this type of candle. How many times? Lots, a few every day. They have so okay. So I'm not saying that they have no sell orders. I'm saying that there are very few. There are substantially few, right? So right here, and so actually the question that you ask is very valid because down here I said that there are still sell orders here pushing price down. They to get rid of those, they take profit right there. They take profit or they have their stop loss close. And now remember that this happens over the course of a couple hours or a couple days because banks don't use brokers. They are direct liquidity providers, right? So they have to use contracts. So it's a little bit different. It's a little bit different, but this is the simple version of what happens, right? So here they push price lower, then they close their order down there as to not lose any money and make some extra money on the way down. And then from there, they just stack their orders down, right? So like if they had sell orders here too, they took profit as soon. So they take profit from their sell position to then get another buy position using this same liquidity, right? So the liquidity that they invested up here to sell and push price lower, they close out and they put it into the buys instead. Yeah, sure, no problem. So from here, right, we understand that there is a void now. Now, before I continue, and we keep using this example, I need you guys to understand something, okay? And I'm actually I'm going to save this album, and I'm going to use these. I need you guys to understand that price has multiple types of imbalances. Okay. So since price has multiple types of imbalances, it's usually like this, right? Write it down. So imbalance. Now, the imbalance can generally be categorized as a inefficient pricing. Sorry, somebody just came into the waiting room. Inefficient pricing of money in the market can also be, a little bit a little bit manipulated, right? Usually this is the direct results of manipulation. Now let me explain what this definition exactly means. So a lot of people are just kind of sitting there like, okay, well, an imbalance is an inefficient pricing in the market. What does that mean? It means that there is substantially more of one side than the other, which is a big mistake, right? So, as we said earlier, what is the algorithm? The algorithm is a series of equations that output a number, right? And that number is equal to price, right? We know that from earlier. Now, since we know that from earlier, what if during one of those instances of this equation, what if the number is substantially higher? Let's say that it keeps outputting, 5, 5, 5, 5, 5. That means, price is just kind of holding steady. And then all of a sudden it pops a 50. What's going to happen? Boom, right? In one go, right? In one number, you just violated the market. Now, this is very important because in this one instance, how the market priced in the numbers, it was inefficient. Why? Because it's not efficient if the banks can't get in multiple times. Like I said earlier, the banks need time to drop their entries slowly. They drip them into the market, right? Like we said in the earlier lesson, right? We said here that they don't just do it from point A to point B, right? They have to establish and drop their entries into the market as time passes, correct? So now, understanding this theory, we understand also that here, right, price will not be efficient in this market. We have to kind of define inefficient. Like, what does that mean? Inefficient basically just means that the banks can't get in multiple times, right? Because then they can't properly use their liquidity. Now, what do I mean by this? Well, the banks are getting in for buys, right, pretty easily. They're just going boom, boom, boom. Right? They're just entering, 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 entering. Now they enter here and they can enter once here and once here due to time constraints. And then what? They still let's say that they have available to them. Let me actually redraw this line just to and actually not use the same number. Let me change this up a bit. Let's actually go with like an actual with like a kind of similar market example. So let's say that price is going at like let's say the algorithm is pricing in at let's say 3, then 4, then 5, 6, 7, 8, right? And then we get a 20, right? So let's put it that way. So the market's just steadily going up, right? And we're not showing retracements, but this is just an example. And then it just fires off, right? In one point. So this is one point, this is the other, right? Now we see that banks are getting in here, they're getting in here, they're getting in here, they're getting in here, they're getting in here, here, right? All the way up to here. Now, at that point, because of time constraints, they can't put in more orders. So they can put in one, maybe two, maybe a third, right? All the way at the top. But you see how that constrains banks? You see how in here banks can't get in multiple times? You see how now they have lost the power to manipulate the market all of a sudden because of an inefficient pricing in the market. So because of this is what makes imbalances so useful. This is what makes imbalances so attractive for banks, right? Now, something that I do need you guys to know is that there is not quite a way to tell when they will be filled in, but you must know that that these prices will be filled in. Okay, they will be filled in it may not be immediate. That's why a lot of people fall for the trap of, hey, the market just opened, I see a huge gap, I'm going to try to trade the gap. Generally not a good idea. Now, the reason why that's not a good idea is because the market doesn't necessarily need to fill in that void. Right? So this is kind of where we transfer over to the actual, like, the vocabulary lesson. So if you guys have your notebooks out, please make sure you guys get this down, okay? So actually, firstly, before I continue to that, does everybody understand what I'm talking about here? Does anybody have any questions? Okay, Jayla, or okay, anybody? Any questions at all? Now would be a good time to ask. And please, I'd rather you guys like ask now, then later you guys try to use this concept in your own trades, and you end up losing money. So please, I don't want you guys to lose any money. Good for now? Cool. Let's go ahead and continue. So as we continue, we're going to look at a couple, two specifically two, which are the two that you're going to see more, and then I'll go ahead and explain the third one, okay? Which has two definitions depending on price action, okay? So imbalances is an umbrella term, and I'll explain what I mean by umbrella term. So imbalance is an umbrella term. So let's go ahead and write imbalances up here. Imbalances. Now this is, like I said, an umbrella term because there are types of imbalances, right? So there's a fair value gap. There's a fair value gap, right? There's a void or liquidity void, right? Right, and then there is inefficiency. Let me let the people that are coming in get in. Cool. All right. So we have a fair value gap, we have a void, a liquidity void, right? And an inefficiency. Now the inefficiency can be played two ways, but I will explain that when I get there. So there's an inefficiency. Yeah, and I'll just leave it like that because I don't want to confuse anybody. So now that we have that there, let me explain. There's a difference between all of these. All of these are different. Okay. These will not just be like, one. Hold on. Okay. Sorry, my screen just decided to glitch out for a moment. Um, let me put it this way. Let me make my screen full screen because apparently I can't make it full screen. One moment. Sorry. My computer's deciding to act up. Okay. So now let's say, so we have these imbalances, right? We have this fair value gap. We have this liquidity void and the inefficiency. Starting off with the fair value gap. The fair value gap is a little bit of a, some people will have some definitions for it, but I will give you the definition that I use and the definition that has helped me the most, okay? So a fair value gap is essentially a group of uneven candles, right? That kind of favor one market. So let me put it this way. Let me actually open a new whiteboard. Let me write it here. So this is going to be the fair. This is going to be the fair. What the man? Fair Okay. And let me put an example to you. Let's say that the market is going in a certain direction, right? And then it drops, comes back up, and keeps going that way. Where do you guys think that the fair value gap is at? Where do you guys think the fair value gap is at? Give you guys the What do you guys think? Initial drop, okay. Where you have sellers, no buyers, okay. Perfect, right? So right here would be the initial fair value gap. Okay, this area right here. Now, a lot of people will ask, why is that why is that even significant? Like I see that so much in the market. Why is that even significant? Well, very simply, that's significant because the market there, right, has a small gap. Now, let's say that this is on the daily chart, right? Let's see where this is on the daily chart. And in this position, sorry, my headset died. So in this position exactly, what we would be doing is we're going to be seeing the market here with more sellers than there are buyers, right? That's how the algorithm has priced it in. So in this particular position, it's a little difficult for banks to price in right there, right? They may have some orders that they didn't completely complete, that they didn't fill in completely, sorry. There may be some orders that they would like to get up there. And yeah, you can just text in the chat if you guys have any questions, by the way. So what's going to end up happening is in this case, price will need to come back up, fill that in, and from here we can be a seller. However, here we want it to fill. A lot of the times we want it to fill, right? We don't want it just to stay there, hit the entry, and we don't want it to just like hit the halfway point. Here now remember that these are mostly going to be on higher time frames. That's where I find them the most. You can find them on lower time frames, but let's say since this is on the daily chart, since this is on the daily chart, what's going to end up happening is that on a lower time frame, let's say we go to like the 1 hour, and this is on the daily, right? On the 4 hour, sorry, on the 1 hour, it will not be a drop like this. It will actually be a series of candles. Right, let me actually draw red for down. It'll be a series of candles that have some retracement. Right, that looks somewhat like that. So it's a group of candles. Now, this is a fair value gap. So now you guys know that there's very little buyer activity here. Now, when price consolidates down here, right, and then decides to go back up, it needs to fill all this. I'm just drawing it a little bit compressed because, it's the end of the board, but you guys get the idea, right? And this actually leads up to more advanced topics like the sell model, buy model, all that kind of stuff. So I need you guys to understand the fair value gap, okay? So it's a gap which is found on higher time frames, which leads into lower time frames that isn't just a single candle, right? But is a group of candles or a significant piece of structure that ends up being filled in later, okay? Does that make sense to everybody? Now, fair value is simply determined that, basically both. Yes, I can. Let me. I can show this on an actual chart. I just need to find one. See where I can find one. Oh, I'm looking on the 5 minute. That's probably why. Oh, here we go. Let me actually show this to you guys. It is no. It is also found. It is also found on lower time frames, though you will see on lower time frames. You will see it a lot. You will see it a lot less on lower time frames. You'll see more liquidity voids and inefficiencies on lower time frames. Let me actually show. So on the 1 hour, would price be inefficient there as well? No. So whenever price is found whenever price fills in another, say an inefficiency, right, gets filled in by another inefficiency, that is not an inefficiency anymore. The definition of a fair value gap is essentially when the market has substantially more of, let's say, sellers than buyers, right? But there is not a steep drop off. It's a piece of structure, and I'll actually show you an example here. Give me one moment. Where is it? Here we go. I'm actually going to look at GA. So this here would be an area that is a fair value gap on higher time frames, because on higher time frames, if we would go back here, let me actually replay this. So let's say like right around here. And fair value gaps can also be gaps. They are also known fair value gaps. You guys see how this is a gap? You guys see how this is a gap between the wicks? You guys see that? Now it doesn't fill in immediately, but when it does, it fills in all the way, which means that that fair value gap has now been filled. Does that make sense? Does that answer the question for a lot of people for seeing it in their own charts? Does that make sense? Yeah? Okay, cool. Awesome. Awesome. Now remember that there is a difference between a fair value gap and an inefficiency. An inefficiency a lot of times can be played from the 50%. However, fair value gaps instead usually are filled. Okay. Now, let's see, Tim. Okay. All right. Cool. I answered your question. Yes, I can. You will always, everything that I teach, guys, everything that Empire teaches, not me because it's Empire, right? Everything that Empire teaches, whether it be the captains, whether it be the educators, you can backtest it. Sometimes sometimes the examples that we give will be drawn, but that's just for the sake of time and the sake of being able to actually draw what we're talking about. But everything that we teach will be able to be back tested. None of what we teach will be just theory. It's backed up by a lot of back testing. So you guys can back test everything that we teach. Feel no shame of that. Now, if you guys want examples or more examples, please text us or say it in the chat. Hey, does anybody have an example of this? And I'm sure any of your peers will be able to give you guys an idea, okay, or give you guys an example. Now everybody understands this. This is a fair value gap, right? Now that's pretty cool because now on the, like, let's say we go back to the hour, this here became a gap. So these gaps here actually end up getting filled in and then completing the motion following up. Now, if we talk about how, yeah, like I said, this was the example. So what else? Oh, right. So this is the example of the next one. Here is kind of an example of the following. Sorry, got in late. Can you give me your definition of inefficiency? So, okay. So we haven't gone over the definition of the inefficiency yet. We've gone over the imbalance, the definition of the imbalance. Let me actually, does anybody have that written down? The definition of the imbalance? Does anybody have that written down? No? Okay. Let me go back to the whiteboard. Oh, whoops. Oh, dang. It deleted my whiteboards. Oh, well. Well, let me very quickly. Okay. Cool. Right. So it's inefficient pricing of money in the market. Perfect. Okay. So moving on from now, we're going to talk. So you guys already understand the fair value gap, right? Now, how do you trade the fair value gap? very simply, let me actually stop drawing and actually go back to how you would have traded this. There's a big difference between daily time frame confluence and you know the confluences that you see a lot of times in lower time frames. Whoops. Hold on. Right. So in this case, you would have, oh, let me actually hit the replay real quick. Here's the replay. Here we go. So in this case, we see this example on the daily time frame. Now, you see this gap here on the daily time frame, which is fine. However, a lot of people don't like trading on the daily time frame, which is also okay. That's fine. However, you could have traded this from lower time frames. So we know that we have this gap here. This gap is going to get filled. Since we know that, right? Since we know that, what do we want to do? Sir, how did you put a TP on GA on your recent trade? What do you mean? What do you mean how I put a TP on GA? I just put the TP on GA. I just typed it in. Or what do you mean? I don't think I get your question. I'm sorry. On 1 hour time frame? You mean on the trade that we took yesterday? Let me explain this real quick, and then I can get to that if you want me to. Okay. Okay. Yeah. Yeah. Sure. No problem. So, in this case, right, there's and here's the difference that I want you guys to think about. Okay. So there's this daily time frame. Now, last class, right, I talked about something called perspective. Or sorry, no, this was on London Snipers. Actually, this was on London Snipers. This was not in class. So let me actually talk about this while I'm being recorded. Has anybody taken physics here? Has anybody taken physics or understands physics for the most part? Yeah? Okay. Well, I'm not going to make this as complicated as physics, but I'm going to simplify this, right? Let's say, and actually let me pull out the whiteboard for this because I actually want to draw it on the whiteboard. This is pretty exciting. So there's something called perspective. So let's say me and you are sitting on the street. Well, no, let's say you're standing on the side of a road, right? Let's say that you're standing on the side of the road. Here you are with your hair, right? And your demonic looking face, right? There we go. So you have, there's you, right? Now let's say that I am passing by in my car, right? Let's say that I am passing by on my car, on my cool Lambo that I got for selling trendline courses, right? Let's say that here I am driving my awesome Lambo, right? Now, due to this, I'm sitting up here. Now, to you, I am the one that is moving, right? You are seeing me move, right? You are standing still. To you, you are still. You are not moving. However, I am the one that is moving in your perspective. To my perspective, my physical body, like me myself, I am not moving from the inside of my car. Right? I'm not physically exerting myself to, be physically moving from point A to point B. However, in my perspective, you are the one that is moving. And I am the one that is standing still. Okay? So you guys see the difference of perspective? How to you, I'm the one moving, but to me, you're the one moving. Right? Because I suddenly lose sight of you. Right? Let's say that I keep going, I have lost sight of you. I can no longer see you. So you have moved from my frame of reference. Right? So let me do a little bit of an activity with you guys. Put your hands in front of yourself and make a little box. Kind of like that ninja glare type thing that we used to do in middle school. You know that? Make a little box with your fingers, right? Now, when you guys make a little box with your fingers, you guys will realize something. Now, with that little box, you have a little port that you can see through. Now, pretend that you can't see everything out of your peripherals, right? And just look around. You see how things disappear from that frame? You see how if you turn to your left, the things on your right won't be visible anymore? You see how if you turn to your right, the things on your left won't be visible anymore, right? Now take this and replace the word time, replace the word frame of reference or perspective with time frame. Perspective equals time frame. Okay, so literally switch the word perspective or frame of reference, frame of view, field of view to time frame. Okay, and you will see exactly what I'm talking about. So now going back to the example on GA, right? If we're talking about how the market is moving right now, on the daily, we see this. So this is our frame of reference. This is our frame, this is our field of view, right? This is our perspective. This is our time frame. Remember that perspective equals time frame. So if perspective equals time frame, we're on this time frame. Now let's switch our perspective. Let's take a different look at the chart. Let's say we look on the hour. What you saw on the daily, all the way up here, right, which this was like a series of a couple candles, no longer exists. Now you're seeing the market from a different eye. You're seeing it from a different perspective. And because of that, that is frame of reference. Does everybody understand that? Does everybody understand that? Yes? Okay. Does anybody have any questions? Anybody have any questions? No? Not at all? Okay. All right. Well, now that everybody understands that, I will move on. Okay. Now talking about perspective real quick. Again, you guys see how this structure here also left another gap? You guys see that? Right here we left another gap. This is also a fair value gap, right? Now, if we keep thinking about this, how we change perspective, because we changed from the daily to the hour, right? So we see the gap here clearly. Now here, do we see any gap? No. A lot of people would be inclined to simply just sell into this gap, right? And let's say I'm from some company that uses 50 pip stops, right? And I try to target this and I say, oh my goodness, that's 75 pips, 77 pips. That's such a good trade, right? Well, okay, you can take it, but what you don't see is that on the daily, you have a fair value gap to fill and you're coming up to fill it. What ends up happening? Well, price will probably continue up, right? And it'll balance that out. Now, once it's balanced that out, then it'll come back down and try to fill this as much as it can. There you go. Both of your voids have been filled. Now, once that void is filled, now it completes its own price action. So I want you guys to realize something. Just because you guys have a target on a higher time frame does not mean you should be trying to trade into it immediately. There's a very good example of this. Simply because you have a fair value gap here, does not mean that you would have bought immediately from like the next candle, because you would have been in massive drawdown, right? What you're gonna do is, as soon as you do this, right, as soon as you see the time frame, what you're going to be doing is you need, and I mean need to, watch price action individually from the daily time frame. Does that make sense? So you have a target on the daily. Perfect. You need to make sure that price action on lower time frames correlates and tells you, yes, this is a valid trade. Okay. Okay. So right here, you didn't see any really particularly good price action until this happened, right? This break of structure. Since you had this fair value gap there, you would not have bought. You would not have caught this at all, right? But once it returned to previous structure, you could have, right? You could have taken this. You could have taken this small mitigation block right here, right? You could have taken that, and maybe you would have caught it, right? In my case, I wouldn't have wanted to trade that. I didn't like that, right? So maybe that was the week that I didn't trade GA. That's fine, but it was filling voids, right? Since it was filling voids, maybe on the 15-minute, right, a different perspective, it would have been filled in from here, right? And then shot up, right? Maybe this was lower time frame accumulation. Let's actually go check that out. Check on the 15-minute, maybe on the 5-minute. Okay, yeah. You see a higher time frame breaker structure. You see an inefficient candle here. There are some price magnets to go up that way. There's a liquidity pool here that gets tapped, right? Maybe we play this half of the 50% of this inefficiency, we continue higher, right? Every perspective is different. Does everybody understand that? Like, does that make sense? Because I need you guys to understand this before I continue. Can I explain it one more time? Yeah. So essentially, perspective runs like this, right? Uh, Hold on. Perspective runs like this. It's very simple. Okay. And it can be a little bit confusing for people at first, which I understand. But let's take a look at this way. We have the daily target, right? The daily target is up here. We want to fill this in, okay? Now we also have a gap here, which means that possibly there's going to be, a gap in this direction. However, we should not take this trade. Like we should not just buy into it because we want to. You would have been in almost 200 pips of drawdown if you did that, right? So what are you going to do? You're going to make sure that lower time frame price action matches up with your higher time frame target. So you should use the higher time frames to mark your targets, right? So think about it kind of like a sniper, right? A sniper doesn't start zoomed in all the way down their scope. They're not going to see anything, right? A sniper starts with their binoculars, right? Starts with their binos. What do they see? Well, they see the whole battlefield here. I need you guys to see the whole battlefield. Now, once you guys see this, right? They see this gap, they see this fair value gap. Perfect. I see that. Now this becomes my target. Now what do? Now you dial in. So the next step of the process is dial in. Let's say you go into the 4-hour. Okay. You see an inefficient type of pricing. Perfect. Now you would have seen this gap right here, so you would have been a little bit cautious about your actions, right? So you wouldn't have just immediately jumped in. You would have just said, okay, well, I'm going to take this as a target, and I'm gonna see what comes of it, right? Now, with that, your lower time frame price action had to match up. Now, what does that mean? Well, your lower time frame price action, meaning your 1 minute, your 30-minute, your 15-minute, would have had to match up. In this case, it does, right? In this case, it does match up. Well, to us, right? To us, because we're smart money traders and we want as little drawdown as we possibly can, we probably wouldn't have traded this, but we still have to keep that in mind. If it doesn't match up, you know it's going to fill. Cool, awesome. That your target got hit, perfect. But you wouldn't have benefited from it just simply because of the fact that all of your confluences didn't completely fill, which is fine. Which is fine because remember that it's better to have one quality trade, right, than just trying to pick and choose whichever one, just firing our account away, right? Because you guys got to think about this. You guys are getting to the point where you guys need to start putting ones and zeros together. Okay, you guys need to start putting one and one together. So now you guys are trading. Cool. Trade with a mindset like you are actually trading a large amount of money. If you're trying to manage your equity, you guys have to think, okay, well, in this trade, should I take it? Let's say I had $100,000, right? Would I risk 1% of $100,000 on this trade? Yes? Cool. No? Don't take it. In this case, I would not have taken it because it wasn't clean enough price action for me. right? So now the next perspective, right? Perspective is literally like so that example of the sniper, I actually want you guys to keep that in mind. So remember, you start by seeing the whole battlefield. Here, you start seeing the whole battlefield. Here, you see the fair value gap. This becomes your target. Now you zoom in. You see your target, you try to zone in, and you take the trade up to the target. Okay? Does that make sense? Does that make sense now? Yes? Okay, perfect. All right, so since we're running a little bit short on time, let me actually go ahead and finish explaining the other types of gaps. Give me one moment. Let me keep sharing my whiteboard. Here we go. And let me do this. Okay. So we have the next one, which is going to be our void. Now the void has a cool name because it's literally a void, right? So this is a void. And when we see these voids, a lot of time price will look like this. There'll be some consolidation, whatever, and then price will just boom in one candle, one or two candles, right? And then it'll start moving this way. Okay. Has anybody seen this? Has anybody seen this? How many times have you guys gotten your accounts destroyed by something like this? How many times? Be honest. Be honest, guys. This is a no judgment zone. Too many, right? Let me get you guys an example that's going to blow your mind. And a lot of veterans will probably remember this. Because I know a lot of veterans that got absolutely destroyed by this. Hold on. I'll show you guys the most obvious example of both market manipulation and a liquidity void being filled. Okay. I'm going to show you guys this position here. Okay. Now, before I show you guys this little fiasco that happened, I want to ask you guys, whenever I do these classes, do you guys prefer the drawing, or do you guys want me to just do it on chart, or how does it work best for you guys? You like the combination of both? Okay. All right, that's good. Okay. So let me continue out real quick, right, with what I was talking about. And this void, how this void acts is very simple. The void, let me give you the definition of the void. So the void is going to be a substant, well, let me simplify the words. Major one-sided market. Well, one-sided repricing. And there's the key word here. Of the market. Okay. Now, the major repricing of the market, what does it mean by being repriced? Well, the repricing of the market essentially means that it gets pushed lower so that new prices can be touched, right? Basically, a movement in the market that reprices lower. Now, this void, how it's supposed to act is it'll follow the local time frame, um, the local price action, right? The local perspective, the smaller perspective, and it'll start pushing up. And it will eventually fill. Now, our objective, right, from a higher time frame is to make this a target. It should not be a quote unquote order block, or it should not be like, oh, well, I'm going to sell at 50% of this candle. No, that is not how that works. This is a target, okay? A target that you are needing to fill in the future. You are not supposed to use this
as a sign to go short. Right? If you waited this whole time while watching this fair value, while watching, sorry, this void get filled in, and you did not get in on buys, you're playing yourself. And then you try to sell up here, you're absolutely playing yourself. That is not what you're supposed to do. You're supposed to use this repricing of the market to get in on lower positions and then try to buy all the way up until it fills. Okay. Now remember, please remember that these these voids do not mean immediately buy once they start retracing. That is not what it means. What it means is follow the time frames, follow your perspective, right? Zoom in on your scope and look at how the market is acting. And then let's say you get this, let's say, whoops, let's say this is an order block right here. You get in on the order block and then you start buying, or you get in on the order block here again, right? And then you buy again. You have to follow the time frame that you're on, right? So you use the local time frame. So right here, let's say this is the daily. You're seeing the whole battlefield. Now you zoom in to one point. You see an order block. Right? You see an order block. You zoom in. Right, you zoom in on your scope, you dial in, you take the order block, and then you watch its results. Right? That's what you're supposed to do. Does that explain perspective? Does that kind of tie it into everything? I hope it does. Now, I'm going to show you guys an example that's going to blow your mind. Okay. I'm going to show you guys a bit of an example that's going to blow your mind. Now, a lot of the newbies here probably have never seen something like this, but this is the EuroChef 4-hour chart. Now, the EuroChef 4-hour chart around around December of 2014, around December of 2014, there was an announcement made by the Swiss bank saying that they were putting a peg on the Euro, like the Euro Swiss, and that it would not move below a certain point. Well, when the bank says not to do something, I suggest to do it. Right? What do I mean by that? If the banks tell you, "Hey, don't sell beneath this point," there's no need for that, right? Sell beneath that point. If the banks are saying, "Oh yeah, you should buy this because you know it's cool and everything," you should buy it. Yeah, no, don't buy it. Okay. Now I'll tell you the reason why. I will show you guys the most extreme example of both a liquidity void and market manipulation. So the market makers said, "Hey, please don't we don't want you guys to sell beneath this point." Cool, great. There's no reason for you guys to sell beneath this point. We're putting a peg on it. We won't let the market move beneath that point. What do you guys think happened? What do you guys think happened? I want you guys to drop it in the chart in the chat. What do you guys think happened? Everybody starts buying, right? Everybody starts buying. Everybody's like, "Oh, it's never going to go beneath this point." Okay, awesome. That's guaranteed forex buys, bro. I'll make my investor 3 times his account with this buy, right? Once it touches the peg. Okay, that's fine. Except this happened. Oh, they put the peg at 1.8, I believe, or at 1.2, like that, around here, I believe, or around here. And this happened. Let me get the ruler for you guys. This thing dropped a total of 2,376 pips. Yeah, no problem, Joe. 2,600, 2,000, what is that? Yeah, 2,376 pips, guys. That is a massive drop. Now, what happens? You guys see this, and you're telling me that the bank's saying that it's not going to go beneath 1.8, 1.18 didn't influence people? Of course it did. People were buying heavy off this.
They were buying, 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 buying. But as soon as this happened, everybody tried to sell. Well, people went bankrupt from this. Literally, brokers went bankrupt from this. People got their careers ended over 2,300 pips from market manipulation. Now, what does this look like? This looks like a liquidity void, right? You have a void starting from here, ending here. What happens later on in the market? It's filled to the pip. It gets filled, and then it drops. It gets filled to the pip, and then it drops. So if that doesn't show you the power of the of the type of trading that we do, I don't know what will. The most obvious form of market maker manipulation, and it follows how we trade, kind of insane, right? Mr. Verma, yes. Well, they did and didn't lie. They just kind of masked. So this is the thing why I don't trade fundamentals. I trade fundamentals for the only reason that fundamentals allow you to know when and if volatility will be placed into the market. Only when and if the volatility will be placed into the market. Let's say that because there was news that January 15th. There was news. And it was something about like the Swiss bank like crashing or something like that. Right? It's fundamentals are excuses for the banks to inject volatility. Write that down. Fundamentals are an excuse for banks to inject volatility. Okay. Write that down, guys. So fundamentals are an excuse for the banks to inject volatility. So Levi says stop losses were probably worthless. Oh, absolutely. Banks had stop losses around here. Well, not banks, but hedge fund managers and trading groups had their stop losses here. It moved so fast that brokers and like the liquidity providers literally could not. They could not make their stop losses valid. That's why brokers went into debt. They closed. They declared bankruptcy because of this move. Now, this happened on all Swiss pairs, GBP CHF, AUD CHF, right? It's inject volatility, Tiana. Yep. So you guys see how the market followed us to the pip, and at the same time it filled in this whole void. So this is the biggest example of a void that I can find or that I can think of, and I'm glad, Tim, that you told me to look more on the charts, because a lot of people like to visualize them on the charts. But here's the biggest and most broad example of this. Let me just put it that way, very simply. And now on price action on the lower time frames, right? We can very easily see accumulation here, right? We can see the order block being mitigated here, another order block being mitigated here, right? So we see a lot of order blocks, we see a lot of price action that's showing bullish confluence. So once we see that bullish confluence on lower time frames, then we can take buys if we need to. You see this gap getting filled in, right? So that fair value gap here, boom. We see this fair value gap getting filled in. So we see a liquidity void, and we see a fair value gap, boom, boom. And you guys see why you shouldn't sell into gaps? Because look, you guys see why you shouldn't sell into gaps? If you would have sold into that gap, you would have been stuck in 1,220 pips of drawdown. So your mentor that keeps telling you to sell into voids, don't listen to them. That's not true. They have power to deliver such a false statement in front of the whole world. Yeah, they do. Because let me ask you something, Mr. Verma. Who has more money than the banks? Nobody. Nobody has trillions of dollars in the market. They do. They have enough money to move the whole forex market. That's why we trade with the banks, not against them. That is why. Now this here we could possibly see, a fair value gap. We see an inefficient candle here, which means that. Oh, and one last comment about all of these voids that I'm explaining. Okay, let me actually write this down up here. Voids are all targets or liquidity magnets. Rarely should you ever use them as reasons for entry. That makes sense. So voids are all targets or liquidity magnets. Rarely should you ever use them as reasons for entry. So simply because price is trying to fill in a void, that doesn't mean you should enter. Now, if there are other confluences, go right ahead. But you should not just use a gap as an excuse. There are certain situations that you will see that you can use them as a void, but rare as an entry. Sorry, but rarely should you ever do them. They are all targets or liquidity magnets. Voids are all targets or liquidity magnets. Now, what is liquidity magnet? Well, price magnets. Sorry, not liquidity magnets. Price magnets. It's the same thing, but it's just different. Price magnets. Okay. What are price magnets? Well, price will be drawn to this position, right? So in this case, price will be drawn to up here. So this was our target, right? This here was our target. So we aimed for that. We dialed in our scope. We saw this order block. We took this order block. We took this order block. And then boom, we wrote it all the way up, right? That is essentially what I mean by both perspective, by trying to dial in, and by the fact that local price action will always be king, right? Because sure, you have these targets, but if local price action doesn't fit in, then you're not going to get there in time, right? You're not going to get there. Voids fill completely, Mr. Verma. They fill completely. They do not fill only the 50%. Inefficient candles fill 50% most of the time. Right? So now you see how this is a target. We didn't use this as a reason to enter. Now you could have in this case, and you would have dropped right into good, into really good profit. But in my personal strategy book, I would not have. And here you have a good example of a breaker block. Look, the origin, the last down candle, this last down candle of the move up that took liquidity, takes liquidity, comes back to, oh man, would you see that? Would you look at that? Right to our breaker and then continue downward. So imbalances should never be entries. Eh, like I said earlier, there is only one that I would suggest you to use as entry, and that is the inefficient. The inefficient candle or the inefficiency. The inefficiency can be used in various ways. Okay, and I may have to cut class short here, but I will make a separate video on inefficient candles. Actually, you know what? I'll just go over it really quickly. Let me go over it very quickly. So the difference between a fair value gap and an inefficiency is that usually fair value gaps are seen in higher time frames, right? And they're not one candle. An inefficiency is generally one candle. Okay? An inefficiency is generally one candle. Let me explain it this way. Why am I not right? Oh, here we go. Okay. So let's say that you are trading an accumulation range, right? Say that you're trading accumulation, boom, you see your straight, right? You see your spring. And then we want to zoom in right to this circle. We want to zoom into this circle. Let's say that price in this case. I appreciate it, Tiana. Yeah, but I have some stuff that I need to finish before 11:59, because college life. But yeah, I'll keep going for just a couple more minutes. I'll explain inefficient candles, and then I'm gonna have to get off. If you guys have any more questions, please text me in the chat. Okay. So now going very quickly over this example, let's say that price action looks something like this. Let's say there's an order block here, right? So we're zooming in to this right here, right? We're zooming into this. Let's say that price creates a little bit of an order block. Cool. But then the candle above it is an inefficient candle, meaning that it has nothing filling in the middle. It's just straight up buyers, right? In this case. Now price continues, it takes liquidity, right? So it took liquidity in this case, whoops. Takes liquidity, boom, right? And then from there, comes back down. Now this is when you use the 50%. This is where you take the 50% of that candle and you can buy from it with your stop loss below significant structure. Remember to make your stop losses make sense. So if your stop loss is like right here, why are you putting your stop loss there? It doesn't make sense, right? Why are you putting your stop loss at the order block? It doesn't make sense, right? Put it below significant structure that make sure that your stop loss is telling you you're wrong, right? So if your stop loss doesn't make sense, well, you're gonna get stopped out, right? So what's gonna happen here is price is gonna continue into this void, and ideally it'll continue an upward, right? Usually when they're in front of order blocks, inefficiencies are perfect. Okay. When they're in front of order blocks or in front of breaker blocks, take the inefficiency. Okay. Try the inefficiency. Now, usually with breakers, this is a caveat because usually with breakers, inefficiencies show that a breaker is valid. Right? Inefficiencies show that a breaker is valid. Now, with these order blocks, right? With these order blocks, usually if there's an inefficient candle before the order block, you can put one entry with low risk, right? With your stop loss there. And if it keeps going, you know that it'll probably hit the order block, 50% of the order block with your stop loss beneath it, boom, and you take it, right? So that's when you want to use these inefficient candles. The biggest difference between these candles is simply that these candles are usually only one candle. They are not two, they are not three, they are not a group, right? In a void, it's a very sharp and significant decline in one or two candles. A fair value gap is a group of candles or a group of structure that has significant selling or significant buying without a significant retrace. Now let me actually see if I can pull this up on another chart. Right. Because I had an example, but this example was super old. Actually, oh no, this is on 5 minutes. The example I showed earlier, yes, was a fair value gap. It was not a inefficiency. Dang, I don't know where to find that. So like right here could have been a gap. It repriced in and then continued upward. Let me see if I can find it somewhere. Because I know I had one. Here's the example of the breaker block that I used. Tap this. Let me see. Oh, chart's not showing? Oh, whoops, hold on. My fault. Sorry. Thank you. Okay. I'm actually looking for a couple. It's unfortunate if we don't get to see this because that was actually like a perfect example of how to use them. Oh, was it here? Oh, it's here. Okay, perfect. So it's right here. So you guys see how price action shot up, right? And we have this order block here before the move upward that took liquidity, right? So this whole move is considered one move, right? It broke previous structure before it, which means that we're good, right? So it broke this liquidity. Now it returns. You see how we have this order block here? The candle before, right? Candle before. And now you see how we have this inefficient candle right here? Well, what would have happened if we would have taken 50% of this? What would have happened if we would have taken 50% of this? And let's actually put it this way. Right. Then remember that it's not just the candle, it's the area that isn't actually filled in. So it's like you see how this right here, this little wick right there is covering. See how this wick is covering? This piece right here is unmitigated. Now you want to take your buy entry off the 50%. Now, once you take that entry off the 50%, stop loss at significant structure, which would have been, either here or there, or you could have just taken it off the bottom of the candle, which is probably the better idea. Choose to put it at the bottom of the candle, or even at the bottom of the range. So like right here, that's fine too. And your first target would have been the first one right here, which, as you guys can see, filled in way more than needed. Can you repeat inefficiency with breaker and OB verbally? Yes. So if there is a order block, like you see right here, right, there's an order block and you have an inefficiency before it, you want to take the inefficiency instead. You want to take 50% of the inefficiency that you see right here that is not filled in, that is not covered by these wicks. Okay. Now with the order block, if you see an inefficiency before an order block, you will notice that that inefficiency is most likely signifies that that breaker is correct, that that breaker is indeed valid. I would still take the breaker, but just know that the inefficiency kind of validates the breaker block. So that doesn't mean that an inefficient that a breaker block without an inefficiency in front isn't valid. That just means that the inefficiency with the block, sorry, but with an inefficiency with the breaker block behind it is a lot more. How exactly is this inefficiency different than an FVG? Okay, so the FVG, you see how this is one candle? The FVG is not one candle. The FVG is a certain piece of structure. It's structure. Remember that. So FVG is structure. Okay. And there can also be physical gaps, like literally physical repricing, right, of the market. However, in this case, the inefficiency, right, is indeed going in the right direction because we just had this buy model, right, and from there continued upward. Okay. Does that make sense? Yes. And then void is the sharp candle, right? So fair value gap usually is structure. You can see them a lot on the daily. I would suggest using them on the daily. The fair value gap can be one candle in terms of the daily chart, right? Or another chart, but and usually with fair value gaps, it reprices very soon. Meanwhile, with inefficiencies, there's really no given time. Does that make sense? FVG does fill completely. Yes. Remember, FVG, anything that has void in it, right? So void, fair value gap, both of them fill in completely. Inefficient candles fill in 50%. That makes sense with everybody. Okay, so I give you guys an example, and I hope you guys are good with that. I have to run because I have to finish some stuff, and I have people waiting on me. So, but I'm glad everybody tuned in, and I'm glad everybody understood. I'm glad everybody had a good class today. I hope that the recording of this will be up on both our YouTube and on the back of your your website. So please make sure that all of you guys understand that. And I will see you guys next time. All right. And yes, Mr. Rum, I will. Just let me get some stuff done, and I will be right with you. Thank you. I appreciate it. All right. Thank you, guys. See you guys later.